All right, we are live. Say something if you guys can hear me. I'm just testing it out. Hello, Scott. Let me know if you can hear me. All right, let's. Hey guys, how's it going? Let me just put headphones in here and let's just hang out. And oh, awesome! All right, what's up, guys? I'm just playing around with this. You know what I'm going to do? I'm going to do a little bit of a presentation and just sort of like get my bearings around live streaming, and then I'll just like live stream more often, and just playing around with some of these things. So Scott, hey Scott, um like I always say, I love your last name. I think we're brothers from other mothers. um what else we got Richard, how are you? It's great to see you as well. I've seen you in the comments a lot, Richard, so like it's awesome that you're here, my friend. Timothy, what's up? How are you? Who's gonna win the contest and be the first one to drop a meow in the chat? Timothy, what's up? Oh, and the winner's Richard. Winner. I was waiting. I knew someone was gonna drop it. All right. You guys want to get into this? So I was actually reading an article not that long ago, and it was about like what Ray Dalio's thoughts were on investing in China. And if you guys want to get an idea of what that is, let's just get into it. So I got this like Stream Deck button thing. So look at that. Okay, so um, I guess Ray Dalio, he lists out um 8 items that he thinks are you know what, if you want to talk Tesla, Timothy, we can talk Tesla afterwards. I'm happy to do that. So yeah, we can do that. But so a lot of this might be familiar to you guys, but I thought it's interesting to hear it from Ray Dalio himself. And so the first thing he says is the number one challenge facing China is the real estate crisis and the debt problems associated with that through the financial system. I want to know what you guys think about the real estate crisis. Now, I've talked about it at nauseum on the channel, but like, what do you guys think in terms of like, is this something that they can address, or is this something that's keeping you out of investing in China as a whole? Now, you guys know that I still have a position in Alibaba, um, and I don't think I'm going to get rid of that position anytime soon. Mind you, guys, anyone who's here, Scott, I know you're part of the Patreon. Scott, there's a call for everyone tomorrow. I just finished up the slides. So there's going to be a long call. It's probably going to be around 3 hours or so tomorrow, going over how I'm looking at investing in 2023. But let's go right back into this. So you can see that Ray Dalio, he does say that real estate accounts for about 25% of the economy. Now, that's actually smaller than what I thought it was. I thought it was a bit bigger. I thought it was like 30 to 35, but okay, fine. And the in a high level, the situation is such that predominantly everyone has their investments or has some form of investment in real estate, or a lot of the population does. And Ray Dalio saying that it hasn't really been dealt with early enough, and so he believes that the debt problems have been allowed to spread and will be difficult to root out. Now, here's something that I heard for many, many years, and some of you guys might recall this as well, that one of the issues with the debt crisis or the debt issue in Japan was that a lot of it is primarily denominated in Japanese dollars, and so people haven't been worried about it. So it's interesting how that is once again being stated here, and I understand what he means by that. They could just, you know, they, to an extent, they could print their way out of it. I get it. Um, so we'll see. Now he has no doubt. I've highlighted in red here that they can handle this. But he does expect it'll take time. 2 or 3 years if handled well. I mean, I think that's really optimistic. Look, I really enjoy holding shares in Alibaba, but I don't know if the country, China, is going to alleviate their real estate issues in 2 or 3 years. Now, I understand that's an optimistic line for him, but you know, things take time to clean up, especially with an aging population. And so he does believe that it'll leave some scars, which will likely be more good than bad in the long run because the lessons will stick. And like, if you just think back to like, I don't know, like 5 years ago, um, think of how different the world was just 5 years ago. So it's like, we know how quickly things can change, right? And so, um, I don't know. I do agree that I believe that um, they can fix things. Now, let's just go into some of these comments here. So, um, Timothy asks, "What happened and where's Jack Ma?" Well, I actually saw a news article recently that Jack Ma was in Japan. Now, you guys can correct me if I'm wrong there. Or was it Shanghai? I can't remember. Um, and maybe we can bring it up. Maybe I'll bring it up. Yeah, but I think Jack Ma is hanging out in Japan. I might be wrong. Um, oh, Scott, you'll be there for a part of it. I have to leave to go through an apartment. Dude, I'm gonna be recording it tomorrow, so it's gonna be available to all the Patreons, even if you can't join. This is the big one. This is like the big one that I do every year, and so this is the one that I will record. I don't see the Chinese housing any different from the US before the bubble popped. We recovered in a reasonable amount of time, not terribly worried. Actually, you know what's interesting, Richard? That's actually one of the reasons why um, I'm so hot on the US housing sector. And now, breaking news, guys, Alibaba isn't my number one position anymore. It's the US housing market. And so, um, that seems to be an investment area that's shunned by a lot. And if people think that I'm silly for investing in China, well, they're going to think I'm even sillier for investing in the housing market. But you know what's interesting? Haven't done very bad at all in 2021 and 2022. I think most of the money that my portfolio has made has been from the housing sector. If you combine the last 2 years together, if you just combine this year, you know what? I don't even know. I only had one position that went backwards this year, and but I should tally it up. So China production is central to the world. It's not going to change. More money will continue to flow into China from global demand. That's right. I will continue. No, I'm kidding. I get what you're saying. And you know what, Richard? The other point to that is that um, there was an article put out by the Wall Street Journal about Alphabet investing in or trying to manufacture in India. Well, one of the problems that the article brought up was that um, it's very difficult to manufacture in India because you don't have the federal level support, and each local government's going to make you um, try to they'll try to sort of address their own needs, which is fine, but it's just harder to deploy capital as a large company, and so it's still easier to deploy or manufacture in China. Um, and so let's get back to this. So let's go to number two. What was his number two? So he's saying number two is COVID. Now this one's interesting because um, when I was thinking about the risks of investing in China at the end of last year, COVID was low on the list because I just thought that um, they would address it very quickly. And then, of course, all of 2022 happened and they didn't address it as quickly as you would think that they would. But it looks like, the protests have sent a message. And so, now, even Ray Dalio saying that COVID and COVID policies have weakened the economy and in some cases have led to some discontent. Now, this article was written before the latest protests. And so, have they led to some discontent? Well, have they ever, And so the point he makes that I find very interesting is like he's saying that there are a lot of older people in China. Something like 175 million who are over 65, and most aren't vaccinated, and they don't want to get vaccinated. And why is that? Well, it's similar to the stuff that we heard here, where very few people have died from the disease, and they worry that the vaccine will do more harm than good. And I would say that a lot of people, even in the West, believe that. But I don't know if you remember, at least just the vaccination rates in, I think it was Hong Kong. It's something like 100%. Guys, correct me in the comments if I'm wrong there, but it was crazy to see the level of vaccination um, in the country. But I understand that in like rural areas, it might not be as high. I think in the city centers, it's definitely very high, but I don't know about the rural area. And you know that just goes to show that like even a guy like me, I cover Alibaba, I cover China all the time. There's still things I don't know, right? And so that's why I always say for you guys to, you know, never listen to any YouTuber and take advice from them, because we all have our shortcomings. So now they're saying here, or Ray Dalio is saying that because the old people are vulnerable and not protected, and because the medical system is not protected to adequately handle lots of old people with COVID, this is not an easy problem to solve, though it can be handled in a more targeted way, which is in the works. And I agree with him, and I think that's why they still have been keeping things sort of like locked down. Um, but they really need to move on getting vaccines in the country. Like you just I wish it happened last year. Now I know that they did have an agreement with a German uh, vaccine company, and then for some reason we just never heard any news, and that was supposed to happen at the beginning of the year. And so I'm not sure. Now he's saying that the COVID problem is likely to have a gradually diminishing effect over the next couple of years. The interesting part of this is how he used the words the next couple of years. I think a lot of us are still predicting that they're going to be gone in like the first quarter of 2023. And so I think Ray Dalio is more right than wrong here. I think I think you have to sort of be a little bit pessimistic. Now, with that said, one of my themes, and Scott, I'm going to cover it tomorrow, is every year there's more capital being added to the portfolio. Well, it might be an opportunity to maintain that portfolio concentration in Alibaba. And I'm going to be thinking about that, and where my portfolio ends at the end of the year, and what level of portfolio concentration do I want in Alibaba? Like, do I want it to be do I want to maintain it at around 10%, because it's quickly falling. You get your end of year bonuses and all that stuff and all the savings, and I'm getting a lot of cash secured puts that are falling off because I'm not being exercised on them. So there's a lot of capital being freed up, and so the cash position is building, and I was already in like a 50% cash position. And so does it become 70 or 80% by the end of the year? Who knows? And then how do you deploy that? Well, part of it is I think I want to maintain at least 10% in Alibaba. And so I'll be thinking about that. But I'll be thinking about that from the perspective of maybe we'll have 2023 sort of happen again 2022 happen again in 2023. We got some good questions here, so let's handle some of these. Okay, so Scott, you think PCOB audits break next week? When is the next investor day? So very interesting. I didn't know if I was going to put anything out for this, but I don't think Alibaba is having an investor day this year. If you go on their website, they would have announced it by now, because if you recall, they had it mid-December last year, and it's not happening. So, or at least they haven't put it up on their website. So if they're not having an investor day, you know what I'll do? I'll do like a summary of last year's investor day, not 10 videos. I'll do like one video, and I'm just going to summarize the key points of it. And so we'll yeah. And Richard, yes, Scott and I are brothers. No, I'm kidding. Okay, so Michael Asante. You know what? That's a very Michael, that's a very powerful last name. There's a company called Asante Wealth Management in Canada, and it's like a premier company. So you are among royalty in the Canadian finance world with that last name. Okay, how many positions you think you're going to have when you build your full portfolio. You know what, Michael? Um, I have a weird way of looking at things. I'm never done, if that makes sense. So the way I look at it is I will find a opportunity. And like for example, earlier this year, um, I saw an opportunity in Crocs, right? And I'm sure you guys saw like Crocs did run considerably this year, and that's not like to brag or anything. It's more just, um, despite the opportunity that I saw in Crocs, and despite how cheap I saw Crocs to be, I decided that I'm only going to allocate maybe 3 or 4% of the portfolio into that opportunity. And so I had Crocs. I think I had like 5 or 6 others. I can't remember exactly how many, but I didn't see enough opportunities to exhaust all the capital in the portfolio. And then every week or so, I guess I get paid every couple of weeks, but every couple of weeks, there's more money coming into the portfolio because I try and save. I think this year I ran at around 70, just over 75% of everything that I earned end up in the portfolio, and so you can see like that portfolio is growing, right? And so um, my thoughts are, as the year goes on, are there opportunities in the market that I can deploy more capital towards? And um, I really struggled. The last time I was fully invested was March of 2020. You know what's funny about that time? In hindsight, it looks like a great time to invest. But I had one of the wealthiest people that I know. He's one of the richest guys in Canada, and he and I were talking about investing in the market at the time. And um, he said that I was nuts to go all in March or April of 2022. I think I went like 90% in March or April of 2022, and then I did the remainder, I think, in May. Um, and so I was all in. But like what was happening, Michael, is that there's a tracker that the Patreons get access to. And I've always had a tracker that I use to sort of like track the price at like the current price as a percentage of the intrinsic value of the particular security. So I do it on a micro basis. And if we're just in a situation where, everything is 20 or 30% of its intrinsic value, I just have to deploy the capital. You know what I mean? It's like it's almost like taking the emotions out of it. I don't care where the market's going to go tomorrow because my valuations, like from a granular perspective, the models look sound, right? Everything that I was investing in looks sound. Here was an example where somebody actually said that I'm psychotic and I didn't know what I was talking about. There was a company called Dave and Buster's, ticker symbol Play, and they only have 2 locations in Canada. I just happen to live near both of them at one point or so in my life, and I like watching MMA. So like tomorrow there's a UFC. You bet your ass I'm going to be watching it. But I love going to Dave and Buster's to watch UFC, or not UFC. They have Bellator there, and I just know the business very well. And I know that, and this was in May when all of them were locked down, they were taking huge losses. I know that eventually Dave and Buster's will come back. And so at, I don't know, 13, 14, $15 a share, I sat on the bed with my girlfriend at the time and I said, listen, I'm going to be making a pretty big position here. Um, but I just needed someone to talk to who's not going to judge me. And then I took a big position in Dave and Buster's and I said, I think that this will more than double in the next year or two because their cash burn was not high enough for them to no longer be a going concern. And then, like, if you guys look up the share price for um, Dave and Buster's, I think it's around $40 today. Like, you guys let me know, or maybe I'll just pull it up on this other screen here. Play. I'll just type it in quickly. Um, $35. And so, yeah, see, absolutely right. Now, am I always right? No, of course not. But look at that. It went up to like $60. Oh no, sorry, that was before the recession. Yeah, it went up to close to $50, but ended up being right there. And but the point I'm making is that even in that situation, my emotions were saying don't invest. And you got this guy who's worth I don't know, like 2 or $3 billion, 2, 3 billion, and, like, it's not easy to come across billionaires in Canada, you know what I mean? Maybe he was worth 1 billion, I can't remember. Um, Older guy, and, when these old guys who've been around for a long time are telling you that you're nuts, you second guess yourself, but luckily, I have a model system and, like, Michael Michael, forgive me, I just don't know if you're a part of the Patreon, but, like, all the Patreons, they just get access to that tracker, and it's $5 a month, right? And so, um, it allows us to sort of, like, calm our nerves a little bit in tough situations. Um, it's a gamble, but that's so Richard says, "It's a gamble, but that's what the majority or loudest segments want. The great call possibly. China will have to move to loosening the growing political." Yes, yes, agreed, Richard. And you know what? We'll go into more of those. I'll just finish the questions. Yes, Richard, we are brothers from other mothers. Um, Michael's Italian. Yeah, I think it's an Italian firm. Thank you for your answer. Other question: do you think the S&P? You know what, Michael? There's two measures that I'm looking at, and I'm gonna um, actually, there's three measures that I look at, and you know what? I'll just show you guys. Um, this is part of the presentation right now. Of the presentation that I'm going to show to. Whoops. Um, to the see if I can make this larger. I don't know if I can make this larger. There's a presentation that I'm going to show to. Oh no, I can't. Um, that's okay. So I'll just tell you then. So I look at the. There's no great measure. The first place I look at is my tracker. How many of my positions in the tracker are trading less than 50% of their intrinsic value compared to how many are not, right? And right now the numbers are. I'll actually just give you the numbers. So the numbers are. Um, there are. Where is it? Oh, here it is. 5% of the tracker is trading at less than 50% of its intrinsic value. 19% of the tracker is trading between 50 and 75% of the intrinsic value, which means that 76% of the tracker is trading at above 75% of its intrinsic value. So that's the strongest indicator because that's my own ground up analysis that's suggesting that the market is still expensive. But notice that S&P is down 16.5%. The Vanguard Information Technology Index Fund ETF is down almost 30%. Now, I got hosed in mid 2021, or I guess even the first quarter of 2021, when I put out one of my first videos where I said that the technology space is somewhat overvalued. People hosed me and they downvoted the video. And as like a young YouTuber, you kind of get like a little bit worried because like you don't want people to hate you early on. Now I don't give a shit. Like hate me all you want. I don't care. I'm just gonna tell you how I think about it. You just kind of get hard into it. Bitcoin is down 63.5%. But despite the S&P being down 16.5%, there's another couple of ratios that you can look at. So the first one is it's called the Schiller PE ratio. I'll just write it in the chat here. Schiller PE ratio. Look that up. And that is suggesting that the PE ratio of the market is 29 times earnings. And compare that to around 16 times earnings historical. Now, it's not a perfect measure, it's one measure. The next measure is the Buffett indicator. Again, not perfect, but it's suggesting that the market is 31% higher valued than its long term trend. And when I had made that video earlier, when I said the market was really valued, it was two standard deviations above its historical trend. So when I just look at those three indicators on their own, um, my own ground up valuation, the Schiller PE ratio, and the Buffett indicator, it suggests to me that the S&P is still overvalued. And but I never invest based on where I think the S&P, whether the S&P is overvalued or not. I invest based on whether the individual opportunities make sense. Because at the end of the day, I just like consider myself a business buyer and a business owner. Um, I wanna be able to own these positions forever, and so I just want a good entry point, and then I'm happy to just ride it forever. The only reason why I even trade, like, I'll sell securities is because I do so much research and I track so many securities that there's always something in my portfolio that's overvalued that I'll get rid of to redeploy into something that's sort of like undervalued. And I guess right now in this environment, I just have not enough undervalued opportunities, which is why I'm in so much cash. Now, this is my buddy Khan. Um, Huge meow. Now, you said you were going to take me for a coffee. You've never done it, and so I'm waiting on that coffee, my friend. Um, Hey Tay, is there a good way? Oh yeah, if you Amit, if you just shoot me an email. Now the problem is I get so many emails that I have been behind on responding, but I think email is the best, my friend. Okay, so let's continue on in with Ray Dalio's um, challenges that he sees for China. So this is oh, Michael. Thank you, Michael. You're great. Honestly, you're great. Okay, so the 3rd challenge that and I'll make it bigger for you guys, and I'll just scroll up a little bit. Can I do that? Yeah, okay. So, guys, this is my first stream. Just bear with me. I'm figuring it out right now. But okay, so he's saying that the 3rd item that is a risk or a challenge with China is what do the China policymakers or what are they doing with capitalism, specifically tech companies and the common prosperity movement? Now, and they're both having both direct and indirect adverse effects on markets and the economy, and we all know this, right? Um, and so, um, I'll give you my perspective, and then of course we'll look at his, and I mean his matters more than mine because I probably have like 2% of the level of intelligence that Ray Dalio has. But I'm trying, guys. I'm trying to get smarter. But with tech companies, I don't think you're going to kill your golden goose. Golden goose, the goose that lays the golden egg. I don't think you're gonna, you're not gonna go after Alibaba. You're not gonna go after Tencent. Look, I understand that they could go after Tencent from the perspective they don't want their children to be addicted to video games, or they don't want their society addicted to gambling or anything like that, and so they'll kind of like cut that out. I don't necessarily see a problem with that either. Yeah, like I don't mind. Like I have two sort of thoughts on that. One, I believe that parents should decide on how to raise their kids and how much screen time their children should have access to, like gaming screen time. But at the same time, it's like if you know you are less dutiful people, um, is there a larger body that comes in and says, "Hey, you know what? Maybe we shouldn't allow our children to, as a society, maybe we shouldn't allow our children to um, play so many hours of video games." Now, I will always side with the parents, but I see the argument from sort of like um, a more like top level approach. But it's a very tough thing to navigate. Obviously, we don't live in that culture, and it's very hard for a lot of us to understand it. Uh, but it sounds to me like their intentions are somewhat pure, based on limited knowledge that I have. However, it has impacted Tencent. Alibaba, on the other hand, it really hasn't. There isn't anything that I think, and you guys let me know in the comments, um, if there is like anything. Um, or shoot, I forgot what I was saying because I'm reading your comments. Oh yeah, sorry. I let me know if there's anything where they went after Alibaba. I just don't think that there's any sort of like business or industry where they really went after Alibaba for other than the one that I mentioned, which was the food delivery service. But for some reason, their food delivery service revenues were up when I expected them to be down. So um, I think common prosperity is a bit of a fugazi. I don't think you hurt your companies with common prosperity. And so right now he's saying that, prices are very cheap if China policymakers do what they say they're going to do. And the impending storm on the horizon doesn't include a major worsening of tensions with the US. And he's right. So When you invest in China, you kind of have to take a position. You either say the prices are cheap because um, you don't think that they're going to kill their economy, or you don't invest in China at all and you say that the economy is going to worsen. So I take the position that cooler heads are going to prevail. Otherwise, look, people are already protesting on the streets, right? And what happens if they start killing these companies that are hiring people, right? It's not it wouldn't be good for the local governments, and so I don't think it becomes a huge issue, but I might be wrong, right? And so, will China remain a capitalist friendly environment that's open for foreigners? Well, here's what Ray Dalio says. He says, while important changes are in the works to get the balance between capitalism and communism right, many people who aren't informed mistakenly view this view as an abandonment of capital markets and entrepreneurship. And I disagree with that, right? And so I'm glad that Ray Dalio agrees with me where he uses the word mistakenly, right? And so it couldn't be further from the truth. It's now well accepted amongst Chinese leaders that entrepreneurship and efficient capital markets are good for China. That's what I've been saying this whole time. Um, but nobody agrees with me for some reason. People think I'm crazy for investing in Alibaba. Still, the perception of the risk for capitalists and capital markets is having a negative effect on markets. Agreed. So, Ray Dalio and I agree here. So, you know, um, if I look at myself as a broken clock, at least I can be right twice a day, right? And so it looks like I'm right there. Let's go back to some of your before we go into common prosperity. Let's just go back to some of these comments. I want to make sure. Um, is there a comparable? You know what? That's a good question, Jonathan. Is there a comparable Schiller P ratio to look at to get an understanding of how China's? You know what? The easy answer to that is China's going to be super cheap relative to the U.S. Um, Even if you just take the current PE and compare it to the US, that'd be interesting. If somebody can do that and let us know, that'd be very interesting to comment on. Um, Richard. Oh, yeah, exactly. Um, yeah. Um, yeah, Kenneth Schill yeah, very yeah, you know what? I if you were to ask me in 2010 if, I could trust Chinese, equity statement or like financial statements, I'd say no. And that's because there was a big story about like a tree company that was falsifying the number of trees that they had. And at that time, I was still in working for a big four, and it was a big issue in Toronto because it was a Toronto big four accounting firm that was the auditor there. And so, but over time, I felt that I could trust them more and more. But there is a Richard, you make a good point that there is a case for a bad apple or a couple of bad apples to be in there, which is the same in North America as well. I kind of feel like the headwind has turned into a tailwind. China needs these two for chips. If they kill them, it would be a detriment to the security of the regime. Very good point, Scott. Um, Alibaba does design chips. They also have some of the best engineers and developers in the country on staff. So does Tencent. And I would say Tencent probably has the most, like, the best developers of any company in the world. Maybe minus, like a Microsoft or an Alphabet or maybe even like I don't know, like Tesla. Maybe I don't know, but like um, you're right. Do you think it's possible that Baba gets through Ant overhaul and they delay IPO until the price adjusts appropriately? I don't even know if they IPO in this environment, to be honest. I just don't know. Um, I don't know. Um, Considering how far Baba has fallen, you know what? Sorry, Scott. I didn't finish my thought there. I think it's probably best if they don't IPO Ant right now because the market valuations are so low. And in fact, I would encourage companies um, that are in industries where the valuations are highly slashed to wait, right? Like, unless they have to IPO, I would say wait until the markets improve. I think it's not a good time for IPO to and to IPO. And in the meantime, we'll just collect that cool cash because it just gets reflected in um, Alibaba's earnings, and so, like, you'll see it in the income for equity method securities, I believe. Correct me if I'm wrong, guys. And so, we still make the money, and my and all of our or the current share price does not reflect any value from Ant anyways. So it's probably better that we hold on to it for as long as we can. So I'm on the boat where I don't think Ant should IPO. Here's a great question. Chickens, guys. Considering how far Alibaba has fallen, what lessons, if any, have you learned? What essentially what do you like? Do you do anything different next time? Okay, so um, I think there's always a lesson to be learned, even when you make money, because I feel like sometimes I make the most mistakes in securities where I make money, and so here's one where I didn't make money. Um, I would say that my original valuation for Alibaba, I had it around 300 bucks, I think. I just can't remember. I think it was around 300 bucks a share. And what I did when I originally bought it, because I don't know if you guys remember, and I'm fully honest about it. My original position was around 200 bucks, $200 a share. So I mean, I'm more than 50% down. But the question comes to, if I felt like it was worth 300 bucks, should I have been a little bit more selective in terms of my purchase price? Or should I sold a cash secured put at $150? Look, I'm comfortable with $150 or less. Flat, full stop. Um, Now I have brought I've brought the exposure down to under $150 per share, that's for sure. And I've publicly shown you guys how I did that. Part of it I did like a tax. It wasn't really a tax loss sale. All I did was I moved it from a non-tax advantaged account to a tax advantaged account, and then, I'm at the highest income tax bracket in Canada, and if you guys know anything about income taxes in Canada, they'll take more than 50% of your income, and so if I can move that whole Alibaba position and then take that whole loss and monetize 54% of that, it's a good move, and so I did that. And then, of course, I have sort of like an accounting log, and I adjusted my cost basis down. And then I sold a cash secured put where I adjusted my cost basis down again. But I would say the biggest lesson that I can learn from this is a lesson that we all have to pay attention to. And a lot of people will um, they'll disagree with me on this one, but I'll just run through them. So it really just comes down to focus on the four things that are the most important questions when it comes to investing in any company. Now, I'm not going to name any names, but there's YouTubers out there that say, "Hey, I got this this 12 point strategy. Look at these 12 things in a company, and if it passes that, then it's perfect." Or, let me just run this quick DCF, or let me just, take EPS and roll it out, and if it makes sense, it makes sense. None of that makes sense. Really, none of that makes sense. And you would like I've spent so many years talking to people on the buy side, from the time that I was on the sell side. Because if you guys aren't aware, the buy side will purchase research from the sell side, and we have better models than what the buy side has. And the reason why they purchase our research is because we focus in on specific industries. So, like, I would focus on utilities, power, renewable energy, midstreamers, etc., oil, and we would focus in on these industries, and we become experts on these industries. And in Canada, the oil business is a good business to be an expert on. Um, and what I learned from doing that is that there is no way that you can just like half ask an analysis. And so, what I would say is, you got to answer those four questions, and you got to be honest about them. And so, what are the four questions? Number one, is it an easy to understand business? With Alibaba, the question is, it's not that it's not easy, it takes time. I don't know how many of you guys have seen my Alibaba model. Guys, comment if you have seen the Alibaba model and how much detail is in that model, like, for you guys who are on the Patreon. I think it's like a 300 line model, right? The reason why we made it a 300 line model is because we tried to understand every single business segment, and understand what the economics look like. Now, I did that right the first time when I bought the shares. I was one of the few YouTubers that predicted that China commerce is gonna decline, considerably, and in fact, actually, China commerce did, I think, 1% better than what my forecast was. The second question is, does the company have favorable, economic characteristics? In Alibaba's case, it absolutely does. I don't think there's a single person who thinks that Alibaba is, a going concern risk or, gonna lose competitiveness into the future, and I've talked ad nauseam about this. The third one is, um, is there, is the ownership, like, does the ownership operate from the perspective of, um or are they capable and willing to work on behalf of the shareholders? I would say for the most part, yes, but for those of you guys who have access to the tracker, notice how Alibaba's name is not highlighted in green. Why is Alibaba's ticker symbol not highlighted in green? And for those of you who don't have access to the tracker, the green just means it's like a great company. So it's like you got your average companies, you got your so-so companies, and you got these great companies. And Alibaba's kind of like in the middle. It's almost great, but it's not perfect. And the reason for which is because they pay out such a large amount in stock-based compensation. It's around 20%, 20, 25%. And so when I value Alibaba out, I deduct the stock-based compensation. So I do a net stock-based what is it called? A net stock-based compensation valuation. Um, so I would say that, um, you would take a point against companies on that third question if they pay out more than 10% of their, free cash flow in stock-based comp. Now, here's where, the mistake comes in and the lesson learned comes in. The fourth question is, does the company trade at a favorable discount to its intrinsic value? Now, is $200 when you're valuing the company $300 a favorable discount to its intrinsic value? Um, in hindsight, I would say no. And that's why I've been very picky on Microsoft. And I know a lot of you guys are like, why aren't you just buying Microsoft? I'm waiting. I'm waiting. And I've done well this year. Like I was looking at the portfolio today and I think it's up 17% this year in with a market that's down, 16%. So like it's a huge outperformance. But I still feel like I could have done better, and one of the ways is just be a little bit more conservative when it comes to my entry points, and look, if I miss opportunities, I miss opportunities, and I think I've done a much better job of that in 2022. So, I hope that that was a good and thorough answer, um, because, if there's anything that I do, I try my best to sort of, like, be, introspective and, um, you know, I don't know. Um, I I try like, I'm trying to get better as time goes on. I still think that I'm at, like, 3% of, like, what I can be in the future. Okay. Um, there's a whole rumor for, 1,000,000,000 ant. What does that mean, Scott? Scott, let me know what you mean by that. I'm sorry, I'm just not smart enough to understand what that means. I'll move on. Oh, like a $1,000,000,000 ant fine? I heard about a fine get issued recently. I'm not I'm not up on it. I'm gonna read into it. Man, the news happens so quickly. Um, yeah, pretty comprehensive and conservative work. Yeah, I would agree. And I always tell you guys that like take my models, but then put your own like re- determine if you agree or you disagree. Like for example, there's a boat maker, and I don't think I've talked about this boat maker on the channel. I think I'm incredibly pessimistic on them to the point where I'm not investing in them. But if another set of eyes looked at them, they'd say this company's worth 40% of their intrinsic value. So I might have been too conservative with that one. Um, going back to one of the first questions, Baba announced on December that the previous investor day would be December. So next week, if that's announced, you're probably right, Tay. Yeah. Um, let's see. It'll be a bummer if they don't have their investor day. Um, I was really looking forward to it, especially with respect to like the cloud. Like Alibaba's investor day is like to me what like Valentine's Day is to my wife. Like that is the most romantic time of my year because I get to learn everything. I'm a huge nerd, right? I like looking at this stuff. I like learning about the business, and so it's a great time in my life. Baba's grooming 200,000 live streamers. This is aggressive. How long do you think this investment will play out? Tell me more about this grooming of live streamers. Are you talking about just like people who stream on like Taobao and what's the other one? Like basically just their online apps and they stream to sell products. I've been saying that that's going to be a phenomenon that comes into North America as well. It's only a matter of time until you have live streamers on Amazon. So you open up the Amazon app and there'll be a live tab or something, and you'll see people live streaming on Amazon, and that's coming because it works. Some cloud insights. Um, just the word groomer is a little bit weird, right? At least it's been like political this year. So let me know what you're thinking by that. Some cloud insights. It's a little silly when they talk about weather impacting their business, and the stock-based comp is absolute killer. I pray they work to bring this down. Yeah, me too. And the problem with even the way that I value uh, stock-based comp as a percentage of intrinsic value is that if the share price stays lower for longer, then the valuation that they issue the stocks at might underprice what what they would actually repurchase the shares for. And so you guys see how I do it in the model. I take a percentage of free cash flow excuse me, or a percentage of revenue as a deduction to owner's earnings, essentially, right? Um, I might have to tick up that percentage. Essentially, is what I'm saying. Um, I haven't taken a position on the share price yet, but if I do take a position on the share price, which I'm going to have to do, because I'm going to have to take a position that the share price is going to increase, I'm going to have to increase that assumption. The only reason why I haven't really done it is because I am so pessimistic on the revenues. I think they're going to grow revenues a lot faster um, than what I am forecasting in the model. And so far I'm okay with that. You know, it's actually funny. There was a commenter on somebody's videos. I watch. You guys probably see me all over the internet, like on YouTube. I watch almost every YouTuber's videos, and I'll drop a comment in their videos just to help with their algorithms and stuff. And there was somebody who said, "Hey, I don't think you know how to value stock-based comp." And I'm like, "Well, I got 100 models here. Take a look for yourself." Um, oh yeah, okay, so that was a good answer. Okay, I'm glad. And feel free to ask me about like lessons learned or like things that I think that I can do better, or even give me like constructive feedback because um, the worst thing you can do, and I'm not going to name a name anymore. I'm done with that. But like the worst thing you can do is come online and tell people that you're the LeBron James or the Michael Jordan of investing. That tells me that you're not experienced because um, the days that I thought I was the LeBron James or the Michael Jordan of investing um, were right before I got humbled when I went into industry and I started, you know, rubbing elbows with, number one, number two, number three ranked analysts in Canada, and I realized, oh, I don't know shit, and I have a lot to learn. And there was a lot of, when I started in equity research, investment banks are no joke. I would say the first 6 months easily 85 to 90-hour weeks, easily, because I just had a lot to learn. And I still, to this day, I still work, with my regular job plus like the YouTube channel. I still do around 70, 75-hour weeks. You just become what you become, right? So, China stock is the next big thing. Well, let's hope soon. Let's hope. We'll see. Yeah, exactly. Lazy investor, live stream to sell products. So the crux of it is that it works, and the reason why you know that it works is because so many YouTubers have affiliate links to sell products. Um, like, have you ever searched any kind of product? There's always sort of like, hey, look at this link in my description if you want to buy the product on Amazon. It works. That's the thing, and so I'm surprised that it hasn't come to North America as soon as as soon like as fast as it should have. I was expecting it to be here 4 or 5 years ago. but it just hasn't made it yet, but it's coming. Mortgage bond is in deep trouble. What do you mean? Are you talking about China? Or are you talking about the U.S.? Um, okay, so let's go back to Ray Dalio's comments and let's see what he says about common prosperity, shall we? Okay, so as for common prosperity, I think that it's a good thing if done well. And so what he's saying is the question is how to move to common prosperity. The question is how this move to common prosperity will work. I think that's the $1,000,000 question that everyone has, right? So, for example, right now, China doesn't have capital gains taxes or inheritance taxes, and its income tax system, the social support systems, and the regulatory systems aren't adequately advanced. To that, I would also add they don't have property tax. And one thing that I was sort of going after, at least this year, is that why not um, at least continue um, your move towards at least charging property tax for the richest or largest pieces of property, right? Um, it's widely known and accepted that if you got $1,000,000 house, you're just going to pay higher taxes, and that's it. And like, the first time I bought $1,000,000 house, um, I was shocked at how much more the taxes were on it. I was analyzing it before I purchased the home, but it was like it was considerably higher than like the original place that I was living in, and the way I think about it is like the community really uses that, and it's something that's really entrenched in sort of like society here, both Canada and the U.S. And over time, it's something that could get entrenched as well in the Chinese economy. I know people disagree with me on that, but that's how taxes work. You start slow and you sort of broaden them out. And so he's saying Chinese policymakers can and should develop a system for creating common prosperity that its people and the world understands. I think that's the key, right? The people and the world understands. That is because the ambiguity and abruptness of this policy shift causes big problems. I agree. I just don't know how to think about common prosperity right now in China. And it's been a bit of a nothing burger as far as I'm concerned so far, but it can turn around and become a big issue. Now, the same way that we looked at COVID at this time last year as a risk for China, common prosperity could be the same thing for 2024 or 2023, sorry. Um, so like it's all these like outlier risks that we can't discount. Okay, let's go back into some of these. So this is the link to cultivate 20,000 influencers on top of it. You know what? I don't see the link, and you know why that might be, lazy investor? It might be just because YouTube automatically removes links. So if you want to email it to me, uh, e- email it to me, tay.moremoney@gmail.com. I'll take a look at it. So the mortgage bond market, yeah, you're right. Um, the good thing in the US at least is that they have locked rates, right? So people can lock in their 30-year rates. And so and the upper tiers are over collateralized. And you know, we'll see how this plays out, but I don't see a reason for mass amounts of default. And the reason why is because the low inventory is going to allow the most troubled investors or troubled owners to sort of walk away by selling their home, even if it's at a deep discount, right? Because like you're sitting on 30 or 40% equity on the home, and you need to like you can't pay your mortgage, you lost your job, and whatever happens, well, sell it for a 20% discount to what you thought it was worth, and you'll be able to fire sell it, get rid of your mortgage, etc. And so it's not what you want for your population to do. But I guess what I'm saying is like just like because there is such a underbuild in the US and because more people are holding on to their homes, like there just isn't inventory to buy, um, you might be able to get away with it. Jack Ma's living in Tokyo. Yeah, see, I heard that. I thought he was living in um in Japan. I wonder if they can headhunt influencers from TikTok. Uh, oh, they're headhunting celebrities. Yeah, that makes sense. And you know what? If Amazon knows what they're doing, they need to get on that right away. Um, because like, there's a big opening right now in the North American market for a products retailer using a TikTok type model. So, like, I don't know if that ever materialized. Think about the money that you would have to throw to launch something like that. But there's a hole in the market, essentially, is what I'm saying. In fact, have you guys ever been on TikTok? I don't use TikTok. I'm I'm an old guy, and the way I look at TikToks is the same way all old people look at it. We see it as reels when we're on Instagram. But have you seen this trend where it's like TikTok made me buy it, and there's a lot of people just throwing up videos of like stuff that TikTok made them buy. So you can see that it's already happening here, and it's gonna get bigger. I think. The market changes in funny ways, right? Okay, so now let's move into the fourth risk that Ray Dalio sees. And guys, keep throwing your questions. I'm really enjoying answering them. Okay, so the fourth risk is the wars with the United States are having a negative effect on economic activity. And he mentions a couple of wars, right? Like, they're in a trade war, definitely in the chip space, technology war, a geopolitical influence war, a capital economic war, and they're now dangerously close to a military war. I would argue that they're not dangerously. I wouldn't use the words dangerously close to a military war. Um, I would say that that's more FUD than anything. But he's smarter than I am, so I'm not gonna like disagree with him. Um, and he's right. This stuff does lead to the inefficient building of self-sufficiency. So that will be costly, and it comes from our returns and our profits, right? So see what happens. And so imagine if investing or producing in China or buying Chinese goods becomes politically like it is for doing things in Russia. I don't think that could ever happen. I don't think we can afford that to happen. So um, yeah. Oh, Eric, you want the link to this? Um, Let me see if I can find it. Ray Dalio, 8 challenges for China. Let's see. Oh, here we go. It's on LinkedIn, and let me post it here, Eric. Eric, I might not be able to post the link. YouTube might not let me post it. So there's the link. Just search for Danger Storm coming, 8 big challenges facing Ray Dalio, facing China and how to deal with them. Um, he posts a lot of stuff. You should just follow him on LinkedIn. It's really great. He posted this in November, and so he's right. But I also believe that like oh, Rob, my boy, Rob, I did see that you sent me an email. I'm gonna read that thing tomorrow. It's on Stone Co. I'm gonna read it tomorrow. Okay, so yeah, I don't think the I don't think that happens. We're too entrenched with the Chinese economy. I think it would be political suicide for any of our politicians. So once again, I think Ray Dalio is throwing a little FUD here. Um, but I always like to say that he's smarter than I am. So let me not say that like I know something he doesn't, right? And so there is a possibility for companies to shift productions like India, Vietnam, Mexico, and investors are doing the same. Now, here's the problem: India, they don't have federal support. Vietnam, just small, right? I'm gonna put out a video on Apple trying to. I made a video on Apple trying to move production into India and the challenges that they're facing. So that's gonna be a challenge. And I also talked about them moving production into Vietnam. It's not what you think it is. It's not another China. Mexico, um, uh, another situation, but I think Mexico is a little bit better. And so this is just why I think that China is so important, and why I believe Charlie Munger, or I believe in what Charlie Munger says when he says that, why can't we just be better friends, right? Like, um, and I hope that does happen. So let's go into number 5. Um, so these are the final 4. So he's saying that the world economy is getting worse in inflation and tight monetary policies. He's right here. And it's bad for Chinese exports and Chinese capital inflows. I think a lot of this goes away in the next 2 3 years. I might be wrong, but I also believe that the years of like 20% growth or double digit growth for the Chinese economy are gone as well. So that's why, if you've noticed in my model, where I forecast out Alibaba growth, I'm only forecasting them at like 7 or 8% a year, and that's utilizing um, a Chinese economy growth rate, a Chinese GDP growth rate of 6% a year. Now, we could be wrong on those GDP growth rates, so um, who knows? But I think the next couple of years could be tough, but thereafter, I think it gets better. I like to be a little bit optimistic there, but you guys might disagree with me. And if you do disagree with me, let me know. It's fine. I learn a lot from you guys. So this environment of great controls and great risk is leading decision makers in all areas to be more inclined to not make this. Okay, before I finish this is the thing that pisses me off the most, where um, you give bureaucrats too much power, and so Ray Dalio nails it, where like these leaders are more inclined to not make decisions than to make decisions that could be perceived as bad ones. This is negative for growth and improvement. And I'll leave it there, and I'll let you guys draw the conclusions as to what happened, what recently happened over the last couple of years, where leaders um, really dragged their feet to make decisions, and it really hurt the economy. But I'll leave that one alone. And number 7 of his 8, demographics are an exceptionally big financial and economic issue in China that is hurting growth in China. There's not adequate healthcare and a pension system that's in place. This creates a large economic and time burden for those in their 40s and 50s. Yeah, because they take care of their adult parents and stuff, and so you know, what's the right solution there? I don't even know if we have the right solution here for that. So, like in North America, and so I don't know. One of the things that they can do to keep the people in the workforce longer is, just increase that retirement age to 65. I know that they're not doing that right now. Guys, correct me in the comments if I'm wrong there, but from what I've read, people in China retire sooner than 65. And here, I would say at least um, there's a big part of the population that just can't retire in North America, and I think gradually our retirement age is just going higher and higher. Um, if this is all I do, like, if my job is just going to an office and just researching securities and building out models, which is like what I do right now, I'll work till 100, like that. So like I'll be on the other side of that retirement age. So now the last one, has there been like he's just concerned about like acts of nature, droughts, floods, and pandemics, and I think that's just a major concern everywhere. And so that's just not a China specific concern. So I think those. I think the last one was like he just threw in, um, and I would say that the climate issues are a bit, uh, less of a immediate concern. But I don't know what you guys think. And so Um, that's it for the article. I wanna know what you guys think. So, like, um, let me see. Oh, there's no other, uh, chat. So, do you guys have any questions for me, or is there anything that you wanna look at? Like, any do you guys have any questions on any particular securities that you want me to sort of, like, opine on or anything like that? Close this. Alright. So for those of you guys who are a part of the Patreon, just remember that we have a call for everyone tomorrow at 10 a.m. And this is going to be a very comprehensive call. We're going to cover all of the opportunities I'm seeing for 2023, and just sort of like how I'm positioning my portfolio. And I'm interested to hear what you guys will say. And of course, it's going to be done on Zoom, so I could like hear you guys as you guys ask questions. And so I'll leave it there, guys. And I'm going to start doing live streams more often. I find these fun, and it's a great way to just like really get my my thoughts out. And so I'll leave it there, and I hope you guys have a really good night. All right, guys. I'll see you guys later.